Meenal, is it still worth putting extra into super if you're charged with Division 293 tax? Do you want to just recap everyone what that Div 293 is?
Yeah, so Div 293 tax is if your income and concessional contributions exceed $250,000, you'll pay an additional 15% tax on top of the normal standard 15% tax on some or all of those concessional contributions you've put into super. So effectively what it means is that the money that you are contributing to super in that concessional contribution is taxed at 30%. And so it's targeted at those higher income earners because if you're over that 250 threshold, then you pay this additional 15% tax.
Yeah. So my own view on this and the next question that Barbara says, when is it worth topping up your super to get a bit of a tax break? There's a couple of themes with these two things. We don't make or not make strategic financial decisions for our life solely based on what the tax thing is first. So for Barbara, she could be 100% in save mode because I'll make a scenario up. She wants to save as much money because she wants to go to Prague next year for 3 months. So she needs as much money as possible to do that, or she wants to take some leave from the workforce to start a family, so we want to pile cash. It might be more important to pile cash and have it here and pay a little bit more tax than pay less tax and have less cash. Pay more tax and have less cash. Whatever. Did I say that right? Whatever.
It all depends on your circumstances, your personal circumstances. So it's really important when you are considering whether you want to make additional contributions, first of all, look at what your situation is, look at what your income is, and then speak to your financial advisor because they are the ones that can advise on that stuff. But, you know, when is it beneficial to top up that super to get the tax break? And so if your income is over $45,000, you're starting to move into that higher tax bracket, which is 30%. And then you also pay the Medicare levy the Medicare levy, which, you know, you're then starting to think
2%.
Yeah, 2% for Medicare. It then becomes a decision about, well, what is that longer term goal? What is it that you want? You know, it's also great for self-employed people to be putting money into super. We tend to see that super is the thing that drops off first for a self-employed person. But if you are looking for the tax deductions, it's about then putting some money into super because what's the point of working so hard if you're not going to get some benefit out of it? And if you were working as an employee, they would be contributing the super for you. So you are being a self-employed person, it's your responsibility to then, you know, fund your retirement. So if you're looking for tax breaks, super is a great one. But it's also then about looking at, well, what is the tax bracket? What's tax effective? But it also comes back to, again, what's the strategy? What's the purpose? What is the idea that you want to be able to fund your retirement, or how do you want that to be? So there is, you know, looking at that tax break, you could use that co-contribution if you're on a low income scenario or your spouse has a low income, you know, making sure that you use that unused concessional cap. That's a great way to get an additional tax break because you're taking advantage of that unused proportion from previous years. It's really important to just look at what your overall strategy is. And you know, if you're getting close to that 250 mark, then maybe it's a conversation to work out whether you should not put in. But the Div 293 tax can actually be paid from the super fund as well. So it doesn't...
Or out of your bank account.
Out of your bank account. So it doesn't necessarily come out of your pocket if you don't want it to. So maybe your strategy is that you put this additional money into super. Yes, you have to pay the Div 293 tax, but the super fund's going to pay it. Overall, that is still a lower tax than what you would be paying in your own personal name. So looking at those marginal tax rates.
Yeah, and for the casual observer, superannuation can get complicated fast, and there's kind of this 3 major tax rates in super, 15% or numbers, 15%, 30% and 0% for pension phase. But there's this 15% internal tax rate in your super that any income generated, it's taxed at 15% internally. But it's also 15% is the tax rate that the government taxes you when you put money in. So to Meenal's question, is it still worth putting extra into super if you're charged an extra 15%? And this also goes to Barbara's question, if I may digress. When we talk about these potential ways to reduce tax with super and, I'm going to put more money to super so I can save less tax, so I can pay less tax, do you have the money to actually put into super? Have you got your budget and cash flow locked away? Have you got your financial goals rock solid? You might have $1,000 in your bank account, but if Rego's due next month, well, no, we've got to pay Rego. So it is about having your system set up and knowing that, okay, I've got X amount left over in my life each month. On this Div 293, if you have all your budget and spending plan in place, you've got your insurances, your sound financial house, you're out of debt, you've got your emergency fund, and you want to build wealth for the long term, if only there was a long-term investment account that was tax effective already set up, ready to go, aka superannuation, what I'm kind of thinking, and this is my own view, if you are triggered with the 293 tax, your income is over 250, which means your tax rate out of super is 47 plus 2, 49, call it 50%, call it 50. On income and money that you receive, here's a question. Do you want to pay 50% tax or 30% tax? I've taken the view that I'm happy to cop the 293.
Exactly, because it's a lower tax rate. So again, it's important to make sure that, like all of those things you just spoke about, that the cash is allocated. You've got your systems, you've got your processes, you've got your plan in place, and this is surplus cash that you don't need, because remember, when you put money into super, it's locked away until that time when you're able to take it out, which, as you said, super is very complicated, and there's a whole heap of rules as to when you can take the money out and the transition to retirement and all of those things. So it's really important that if you're going to make a contribution to super, you understand that the money's effectively gone. You don't have access to it. So if you can do that, if you're comfortable with that, it's definitely better to look at paying 30% tax rather than
47
plus the Medicare.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.